Imagine standing at the edge of a tidal wave of liquidity where Ethereum's renewed institutional momentum is sloshing over the entire altcoin beachhead, and suddenly Pepe, the frog-themed memecoin that once felt like a punchline, is back in the spotlight, printing a near 10% intraday gain as flows cascade from ETH into smaller cap tokens. This is the kind of moment that forces investors to ask bluntly, is a breakout imminent, or are we watching another short-lived meme bounce that will collapse as quickly as it rose? To answer that honestly, we must treat this as a conditional, data-driven thesis rather than a cheerleading exercise. On the opportunity side, there are several tangible reasons the setup for Pepe looks constructive right now. First, correlation mechanics matter. PEPE'S observed price correlation with Ethereum, approximately 0.76 historically. Per the metrics cited, means large-scale capital rotating into ETH often cascades into small cap. ERC-20 tokens, the altcoin lift phenomena, and when institutional products like ETH spot ETFs begin to accumulate at scale. That liquidity doesn't stay in ETH forever. It seeks higher beta and yield among smaller ecosystems, and memecoins are the usual immediate beneficiaries. We've already seen narrative confirming evidence. When ETH registered a strong inflow week for ETFs, more than $1 billion net in a week, with major products like BlackRock's ETF leading, on-chain flows and risk-on sentiment accelerated, creating the environment in which a token like Pepe can run hard for short bursts. Second, on-chain adoption metrics for Pepe give the bulls ammunition, despite a significant prior drawdown. Wallets increased by 25% year-to-date, signaling persistence of retail interest and organic accumulation even through the bear phases. Rising holder counts are a healthier base than pure speculative concentration because they suggest distribution of liquidity across many small wallets, which can reduce whipsaw when more participants want to hold rather than flip. The technical picture has an attractive symmetry. PEPE'S price action forming a symmetric triangle since early in the year is a textbook consolidation pattern that often resolves with a directional breakout when the macro bias turns supportive. Combine that with the liquidation heat map dynamics, short clusters and max pain zones around key ticks, and you have the mechanical potential for a short squeeze to magnify an initial breakout into a quick large percentage move as shorts are flushed and momentum traders pile in. Add in the observed fact that in the last 24 hours, more than $2.56 million short positions were swept. That reduction in latent downside pressure is exactly the dynamic that enables a breakout to accelerate into something bigger. Taken together, these elements create a plausible short-term path. ETH-led flows create by pressure on altcoins. Retail wallet growth and DEX activity provide available demand. Technical compression resolves upward. And reduced short pressure clears the deck for a rally that can outpace a normal organic advance. That's the bullish blueprint, and it's why traders are talking about breakout odds and why PEPE's sudden 10% pop matters in context rather than as an isolated spike. Yet the risk side is equally strong and demands equal weight in any serious risk-reward assessment. First and foremost is concentration risk. The top 10 Pepe wallets controlling roughly 37.5% of the supply is a structural vulnerability that can turn any rally into a trap. When supply is so concentrated, large holders or coordinated groups can appear to buy and accumulate and then distribute into rallies, or they can dump en masse if risk tolerances change. Either action can convert a breakout into a rapid collapse because liquidity in memecoins is notoriously thin at scale. Second, memecoins are sentiment and narrative assets more than fundamental ones. While ETH's ETF flows provide a potent upstream catalyst, they can also create a frothy downstream dynamic where price moves far ahead of real adoption metrics. And that leaves PEPE exposed to mean reversion if ETH's momentum cools, or if institutional flows rotate elsewhere. Succinctly, PEPE'S strong correlation to ETH is a double-edged sword. It lifts on the way up, but follows when ETH pauses or corrects. Third, the leverage dynamics in meme markets are brutal. Concentrated long or short positions in derivatives markets, combined with thin spot order books, create conditions where liquidations cascade, slippage explodes, and participants with high leverage get wiped out. This mechanical volatility often makes sustaining breakouts difficult. A classic 2 steps up, 3 steps down pattern. Fourth, regulatory and macro risk can't be ignored. Memecoins are especially vulnerable to risk-off liquidity. Events, abrupt enforcement headlines, or exchange-level interventions, delisting rumors. Withdrawal limits, KYC AML frictions that can instantly dry up buyers and force price down regardless of the micro setup. Finally, the increase in holder addresses is a healthy sign, but it can be misleading. New addresses can be created for short-term speculation, airdrop farming, or even wash trading in certain contexts. One must verify whether address growth is accompanied by sustained DEX volumes, low exchange balances, and decreasing sell-side intent from large wallets. If the new holders are mostly momentum hunters, a breakout will be less robust than if they represent sticky participants. So, how do we translate this mix into actionable scenarios and measurable signals without falling prey to the hottest hot? Think in probabilities and concrete triggers. Scenario 1. The controlled breakout requires confirmation on 3 fronts. Price must break the triangle to the upside and hold above the breakout level on higher than average volume. Across several sessions, not just a single wick, exchange balances for PEPE should trend down, or at least not spike upward. Sustained outflows to cold wallets or long-term custody indicate buy on hold intent. And the short interest liquidation landscape should show a net reduction, i.e. smaller short clusters remain. If you see these 3 confirmations alongside continued ETH ETF inflows, then the odds of a multi-week extended rally increase materially and a short-term target zone becomes feasible. Scenario 2, the false breakout or squeeze, inverse, manifests when price pops above the triangle on thin volume. Exchange balances tick up indicating selling pressure or rotation. And whale addresses that were previously silent begin to move or show selling intent. Derivatives again amplify this by reloading short positions at higher strikes, so a whipsaw back into the range is likely. Scenario 3. The slow grind happens if ETH's momentum cools, ETF flows pause or reverse, retail demand softens, but whales remain neutral. In this case, PEPE consolidates in the triangle longer, creating a drawn-out accumulation range without decisive direction. Each scenario has different trade tactics. In Scenario 1, momentum traders can scale in with tight trailing stops and plan to take partial profits on measured targets. In Scenario 2, fast risk control is essential. Use strict stops or inverse hedges because squeezes reverse quickly. In Scenario 3, patient DCA and size-light positions work best. What are the precise signals to watch that will tell you which path is unfolding? Start with volume and breadth. Sustained higher volume on the breakout that is matched by rising DEX volumes and falling exchange inventories is the cleanest bullish sign. Monitor the largest wallet flows. If the top 10 wallets continue to hodl and do not transfer to exchanges, concentration risk remains, but so does price support. If those wallets start depositing to exchanges, that is an immediate yellow to red flag. Watch funding rates and open interest in derivative venues. Heavy long funding suggests momentum, but also overcrowding. Rising short interest at higher price levels indicates another squeeze is possible, but also sets the stage for a harsh reversal once the squeeze finishes. Follow correlation to ETH. If ETH continues to see institutional inflows, that's a broad tailwind. If ETH flows fade or reversals occur, PEPE will likely feel it quickly. And finally, social sentiment metrics matter more here than for most assets. A rapid spike in viral mentions and coordinated pump narratives often precede violent reversals. Because those are classic distribution signals, risk management is non-negotiable. In meme markets, position sizes should be small relative to overall portfolio risk if you're not a market maker. and protective stops should account for the high intraday volatility typical of PEPE. For traders who prefer optionality, buying short-dated calls instead of outright spot exposure can limit downside to the premium while keeping upside exposure. Conversely, long-term believers who want exposure but can't stomach rapid drawdowns should DCA into base levels and avoid chasing breakouts without confirmatory flows. Hedging with inverse products or cross-asset hedges, for example, reducing overall crypto beta via BTC-ETH hedges can also protect the portfolio from a correlated pullback. For more sophisticated players, watching on-chain indicators and using alerts for large whale movements provides the earliest warning system. For retail, set size limits and mental stop rules before entering.